Hello everyone. So now after the interim budget, we have seen that the markets again are are at elevated levels, or you can say that the uptrend has continued in the market. So there is no major disruption happened. In fact, there are some positives because overall from the interim budget, because it was an vote on account, there was not much expectation, but eventually the result has come out good. And that is where this optimism in the market has continued. So let us see now going forward in this month also how the markets are going to shape up. First of all, because this is a broad market, stock specific market, we need to understand that where the private capex is going. Generally, we look at cement, where the capex is happening, and then we say that beyond this, there is no major capex from the private companies. But actually, it is not so. I mean, if you look at in the sunrise sectors, we have seen that many private players have entered and they are doing capex. So green ammonia is one of them, which is where the private capex has moved into. Electric vehicles, the market share previously was 5%, now it is 6%. We have seen the two-wheelers have gained, but along with this now SUVs, which have become 50% of the overall passenger vehicles market. So we are going to see more e-SUVs also coming out in the market, and those manufacturers are going to benefit. Solar, so you have seen in the budget also the rooftop solarization. This is what government was talking about for, they are talking about, some crore of houses to be benefited. And this is where REC was chosen as one of the central agency for this. PFC is the holding company of REC. So those financing companies to power, because 25-26 lakh crore of funding requirement is there. If you look at PFC, out of the total loan book, 25% actually is contributed to renewable energy. And still the valuations are not very steep. I mean, the price to book is 1.8 times in PFC. And this is where, these things are happening. And I think this funding will go more into the private players who are expanding into these businesses. You look at wind. So wind also, we have seen that Tamil Nadu is the major hub for wind power. And we have seen that some players are coming out and they are trying to go more into this segment. Batteries, we have seen that Exide industry, it was more into internal combustion engine, and finally they are moving into electric batteries also. And Amar Raja battery also has spoken about, but Exide looks like, because it had a life insurance business also before, that was impacting the ROEs, and ROEs look like they are improving, and that is where those companies are coming out. Going forward, some big industrial houses, they have also announced they are moving into batteries, so that is another way of capex from the private players. Green hydrogen, you know that this is picking up. Some big industrial houses like Ambani, the Reliance, they are talking about going for with a major expansion into this 75,000 crore. They have said they will do the capex. So going forward, we have to see whenever this hydrogen comes out, then the local use of this, is much more anticipated, because it will be available actually locally, and it will be cheap also. And that is where some of the industries which are going to use this, they will also have a major beneficiary, impact. Artificial intelligence, you have seen certain applications have already come out. It is impacting. It is called as disruption actually in the overall markets. But yes, we have to accept this, and that is where the companies have moved into the applications around artificial intelligence, whether these are the IT companies or some other, and that is where we need to keep a focus on. Space is definitely a big thing. The focus of the government is also there, and that is where I think the space ancillary industry is picking up, and there the private companies are doing more capex, and that will throw more opportunities going forward for equity markets, stock picking perspective. Materials research is another way, because we have seen the companies in India, they are looking outside to acquire mines, Jindal Steel and Power, for example, or you take some PSU also, like NMDC. So what has happened, if you see the EV market, China is one of the largest EV market, but there was a slowdown in the country. So as an impact, lithium prices also have seen a decline. So if you look at South American market, Argentina, where the mines are on block now, the lithium reserve mines are on block simply because the inflation impact was already there, and now the lithium prices have also declined. It's an opportunity for the companies in India to go for acquisition and purchasing the mines over there. Domestic tourism, I think it's a big room actually for some the hotel companies or airline industry, etc., etc. And that is where the companies are going for more capex. You have seen that beyond Ayodhya, Varanasi is there, Jammu and Kashmir is picking up, where expectation is there for double-digit growth going forward also, and that is where the companies are expanding. So these are all areas, which are emerging, and the private players are putting money. Electronics manufacturing. So overall electronics market is $2.9 trillion market. EMS is market is $900 billion, and we have seen India has a market share of 2%, and they are going to take it to 7% actually now going forward. So all of these sectors, they are sunrise sectors, and we believe that going forward you will find opportunities in all of them. Now, very important to understand from where we are emerging, from where India is emerging, because all of these things were talked about in the past about India. For example, we were talking about that India has come in the fragile five nations at the time. In the time, I think it's almost 10 years before. And it was spoken about that we are more dependent on the foreign currency, foreign inflows, and these foreign inflows are driving our current account and everything. And along with this, the other nations were Brazil, Indonesia, South Africa, Turkey, and we were named actually among them. But now you have clearly seen that India is going higher, the GDP growth is coming up, and we are easily among the top five nations now as per the GDP. It was also the discussion before that the twin balance sheet problem is there for the corporates as well as for the government. Now you have seen the corporate profitability is growing like anything as a percentage of GDP. Yes, it has not reached to 2007 levels, but it is healthier above 4%. And it has grown from 1.5% during the pandemic period. So the corporate balance sheet has improved. Now the only point is this corporate capex is going to be lined up now. As I discussed in the previous slide, some of the sectors where corporate capex is coming, and that is where we need to focus. In fact, if you look at the listed corporate space, there we have seen 8.1 trillion rupees of capex in the last 12 months, which was absent before, but now it has really picked up. So the balance sheets of the corporates have picked up, the balance sheet of the government, because government has saved close to 1 lakh crore in the when they were importing the crude from Russia, which was at a discount. It was blessing in disguise. And now you have clearly seen in the budget also that the borrowing of the government actually has not picked up. It has remained flat. And despite this, that they have increased the capital expenditure also by 1 trillion rupees. And yes, so they are playing the cards really very nicely. The fiscal deficit is in control, and it is much better than the market expectation. So overall, the bond yields can remain lower because of this, and the cost of capital can also. So this is where I think this is how the India is emerging. And another thing which was spoken about before, that auto sector in India is in deep trouble. The consumption space was not able to come up. There was a high inventory in the auto space. And that is now it is just coming up. So you have seen the numbers are making new highs now. I mean, the same passenger vehicle, which used to be 34, 35 lakhs, now it has crossed 40 lakhs actually. And the CV market, commercial vehicle market, is making the new life highs in financial year 24. So automobile has come back really good actually now. If you look at India, so we were previously, some people were talking about that India should focus more on services. So you have seen that the services are doing good. Yes, some IT companies, they are impacted because of the US slowdown scenario. But eventually, we have seen that the manufacturing which India has picked up, it has picked up. In fact, it is accepted also very nicely by the outside world. iPhone manufacturing will become 50% by 2027. It's a big thing actually for India. Tesla also can start manufacturing in India going forward. 5 lakh vehicles they are speaking about, and because of this, the outside FDIs they are doubling their stake in India. So, for example, Temasek, which is a state fund, they have doubled the stake in India from 3% to 6%. US pension fund now, they are tweaking their benchmark so that their exposure to the emerging markets can increase, and particularly towards India. So we are expecting 35,000 crores coming from US pension fund in this year. This is how moving towards manufacturing has really helped India. If you look at the GDP, it was also spoken before that India GDP may grow even less than 5%. Mr. Raghuram Rajan, in January 2023, he had also spoken about this when there was a collapse in US of around 4 or 5 regional banks. But now IMF has revised the GDP forecast for India for financial year 24. So it is coming 6.7% as per them. On aggregate basis, it is coming actually around 7%. So again, this is where India has outclassed the expectations in the market. It was also seen that banks were sitting on high liquidity before. The credit actually was very low, around 4%. Now the credit has grown tremendously, around 17-18%. Yes, I understand that the corporate lending book has to grow more going forward, but credit overall has picked up. And in fact, there is a scenario that the credit growth is happening higher than the deposit growth. And that shows you that the requirement for funding also for banks. So from a very high liquidity, the banks actually are looking for liquidity. So this is how the trend has changed, and it shows the bullishness in the economy overall. In the pandemic, people advised because US was giving money directly into the hands of the public, and it was advised that India should also print more and give the money into the hands of public. Now you can see the difference. US current account deficit is much higher, and that is the reason the US currency has remained subdued. India has remained more in control. They gave more credit actually through some schemes to the MSME segment during the pandemic. But now they have really, the balance sheet has really improved from the government. Current account deficit is near 1%. Fiscal deficit is projected to come to below 4.5% by financial year 26. And we have seen the bond yields have remained subdued with service US bond yields. So overall, it shows that recovery in India. It was also, said that the government should increase disinvestment in order to decrease the fiscal deficit. Now you are seeing that the fiscal deficit has come in control despite the disinvestment numbers not growing. That it has remained around 50,000 crores even for the coming financial year. That means that the government has really liked the profitability of the PSUs to go higher. They get more dividend actually, and that is where they have taken a lot of initiatives so that the PSU stocks starts performing much better. Efficiency has improved. So all of these things should give you confidence about the Indian markets, and we also need to understand that the growth that India is picking up despite all the skepticism which was prevailing in the last years. Now coming to the budget and looking at the triggers post-budget, government has increased the capex to almost 11 trillion rupees from 10 trillion rupees for the coming financial year. Private capex was not picking up, but in the last 12 months, it has picked up. As I said, 8.1 trillion rupees more than this. Capex to GDP is pegged now at around 3.4% for financial year 25. And that is the thing. I think the capex intensity has continued. and this is something that the market will like. In fact, now the government is talking about that private capex also will come. So government balance sheet is improving because the direct tax collection GST numbers, they have improved. Direct tax collections actually have become trebled in the last 10 years, and the GST numbers actually have come to average 1.7 lakh crore. Last year it was 1.5 lakh crore, and before that it was 1.2 lakh crore average. So the average numbers are continuously growing. That is where the balance sheet of the government is also improving. Fiscal deficit prudence is very clearly, it has surprised the market, in fact, because financial year 25 it was expected 5.4, it has come to 5.1, and financial year 26 even it can go below 4.5. Thus government is focused not to increase the borrowing, and that is where they have kept the borrowing flat, and this can lead to lower bond yields and hence benefiting the overall market situation. So this is what actually is something coming out post budget announcements. I tell you some more points now related to budget, interim budget. So India, the GDP is growing. In fact, India GDP is likely to grow at a triple the pace of the world's GDP. You have seen that India is growing by 7%. The world GDP is growing around 2.5%. Coal gasification is the next buzzing word actually coming from the government, and it is very much required. See, outside we have seen the coal gasification happening. India, it was a more ash rich, ash content was much higher, in excess of 40% in the coal, and that is why it was taking time. But government intent is there, and they want to oxidize the coal actually along with the water and want to create a synthetic gas. This gas can be used further into other like pharma or like chemicals like fertilizers, etc. And that is where a more use of mining coal is going to be seen actually going forward. So thermal capex, for example, because you need coal for thermal capex also, and 70% plants in India are run actually through the thermal capex. And this thermal capex is also growing now, or expected to grow by 20% now in the coming 4 5 years. In fact, it was a degrowing by 1%, minus 1% from 2015 to 2022. So this is a game changer, and that is why those companies actually are coming out which are linked to this. Lower disinvestment target. So as I discussed, 50,000 crore, this is what the government is comfortable with, even though it is not required now to decrease the fiscal deficit because the flows are coming from the other side also. If you see railway focus, though, that railway focus has remained, right, with higher number of metros, 40,000 rail bogies they are talking about to convert into Vande Bharat, dedicated freight corridors, focus on domestic tourism. All of this will lead to higher use of the railways. Another important aspect which has come out is that 1 lakh crore of funding is done for the R&D perspective, for more innovation in electronics, etc. Defense electronics also. It's a welcome step and allow for more value-added products where the margins are higher. Because if you do this, you are able to pay much better to your employees, and you are able to retain the talent also in India. So this is very important going forward. And I think that is how the India is evolving from just the assembly part to the critical component manufacturing parts also. Rooftop solidization, electric charging stations are in right direction. And the focus here on renewable energy, on from all the cylinders, government is trying somehow to increase this. So 175 gigawatt renewable capacity, their target is to take to 500 gigawatt by 2030, and that is where all the things are moving along. Ministry of Defense has again seen one of the highest allocation of close to 6.2 lakh crores. Roads have seen 2.78 lakh crores, and railways have seen 2.55 lakh crores. So that means the government, focus on investment cycle in India has continued. It's very important, and that leads to the stock picking also in our portfolios. The lower tax regime for the corporates around 22%, 15% for the new manufacturing setup, it has remained, and that shows that there is a focus on the long-term sustainable growth path. So these things post the budget have come out as some of the ideas that we thought to discuss with you and how it is going to impact various sectors. On a macro perspective, dollar index has still remained subdued. It is around 104, and we have seen that whenever dollar index remains subdued, it leads to FII flows into the emerging markets. And India, which is growing by 6-7%, it can attract anytime the higher inflows into the country. So this phenomena is good from the flows perspective, definitely. US indices are close or have taken out the life highs. So if you remember when Nifty was at 17,000, that time S&P had come down to the pre-pandemic level of 3,500. And now we have seen that it has recovered, and eventually it took a lot of time to recover, but yes, recovery has come in. And in Dow Jones Industrial was the first one which has taken the life highs. It shows that somewhere the industrial segment is buzzing and that can perform better. Bond yields, if you compare, so there is a softening of the bond yields. Going forward, Indian bonds are going to be included in the JP Morgan bond index. So it will lead to $23 billion of flows. Then Bloomberg and then Russell, all of this is going to happen. So the treasury profits of the banks can increase because of this lower bond yields. In fact, vis-a-vis the US bond yields, our bond yields since May 2022, if you compare this period with this period, it has gone up. Rather, our yields have not taken out those higher levels in the last 1.5 years now. If you look at the GST flows, yes, it has remained above 1.6 lakh crore. As I discussed, along with the direct tax collections, GST collections also have remained quite robust, and it is increasing every year actually by 20,000 crores. So previously it was 1.2, then 1.5, now 1.7 on an average lakh crore it has been. SUVs in the automobile segment, SUVs have grown higher. Financially at 24, they are closing with almost 59% of the overall passenger vehicle sales. So it was 50, now reaching to 59%. In fact, going forward, it can go above 60% also. So there is a good SUV dominance happening in the passenger vehicle space, and that is where the manufacturers who are more focused into this segment, they are going to be the direct beneficiary. Commercial vehicles also have picked up. It is well poised to make a new high in financial year 24. So you can see here, this will be the new life high with 10.5 lakh units going to be sold in this financial year. There is another focus of the government now for the increase in mining. In fact, Mr. Prime Minister had called the mineral minister also that which are the critical minerals in India where we want to become Atmanirbhar. So whether it is iron ore, coal, copper, manganese ore, those companies are likely to do better. NMDC, for example, you have a case here where the sales growth, actually it has sales, overall has remain around 30 million ton. This is the sales volume. And now financially at 24, it is going to close closer to 46 million ton. And then in another couple of years, another 10 million ton will be added. So this is where these mining companies are doing better. And I think if they acquire the lithium reserves also going forward, it will be a good strength for them. Coal India also, the coal sales volumes, as I discussed, they are also increasing. So overall, the mining seems like it is doing better. In fact, government is also benchmarking the iron ore prices to the global indices, and also the government, is looking to lower the imports of fossil fuel, and that is where they want to do more mining on a domestic front. Electronics market exports, is growing from 24% to 640%. This is what the expectation by financial year 26. So you can see here that from 102, billion dollars, it is likely to move to $300 billion. So exports from 24%, it is likely to grow actually much better to almost 40% of exports. Ace Equity, this is our flagship product based on all the things which we have discussed today. It is when we look for investing our money in the emerging markets, like renewable energy, like railways, like semiconductors, data centers, 5G applications, power, telecom, APIs. So there are all these sectors, which are emerging now, and even drones. So that is where we are focusing in Ace Equity portfolio. And there are two primary things, in this portfolio, that we have kept the price to earning lower than the index and EPS growth much higher than the index. This is the key to success. We believe at these levels, when the Nifty valuations are elevated, you cannot have elevated valuations for the stocks. Whatever you have to buy, keep attractive valuation. And also remember that the sales growth of your stocks has to be much higher than the index. Then if you follow this, I think the money making can be more superior. This is the performance of Ace Equity portfolio till January 31st, 2024. You can see across the time frames, we have outperformed the benchmark. We have outperformed in the last 1 year by almost 22-23%. So significant amount of outperformance is shown by Ace Equity. And the reason being that it is focused on the new sectors, emerging sectors. I discussed about the private capex in the sunrise sectors. I discussed about all the emerging themes. So this is where our focus area is, and we really like those sectors which have not performed in the last 10-15 years, and they are all coming out. That is where our focus is. Every rally contains its own leaders, and that is where actually we are focused to pick the stocks. Few examples from this portfolio. Lemon Tree is part of it. This is the only mid-segment player actually in the hotels, which is in the listed space. It had some debt in the books, but we believe the way the occupancy rate is picking up, the way average room rate is picking up, ultimately it will be able to pay off the debt, and that is where the stock is really performing nicely. So we have better targets going forward, much better than the current levels, and that is why we still hold the stock in our portfolio, which was bought at much lower levels. NMDC, I have already discussed about this stock, that the sales volume growth, which was around 28-30 million ton, it is moving to 46 million ton in this financial year and going ahead by 55 million ton. So this is also doing capex after 2000, after 13 years almost, it has started closing above 200. It has consolidated, but I think the risk reward is better and it can perform better actually going forward. BML also was taken in our portfolio around 24-2500 levels. We are holding it because we believe there is whatever segments this company is catering to. All of these are high growth segments, whether it is railways or metros or mining or aerospace or defense. All of these are high growth segments, and the order book position of this company is going to increase faster, in fact, much faster, because only from the metro segment, they have got the orders from Chennai Metro, Mumbai Metro, Patna Metro, Bangalore Metro. And going forward, there will be more mining equipments requirement, because government has allowed the private players also. As I discussed before, the mining requirement is increasing. So government has allowed the private players also, and that is where more mining equipment requirements will be coming, where BML is the primary candidate. Mining and construction holds around 50% of the overall order book positioning of this company. Lastly, Jindal Steel and Power, which is also part of our Ace Equity portfolio. We believe the margins to become better. They have commissioned 6 million ton, per annum of HSM, which is the hot coil capacity. And I think this company is really doing well. They are the only one who is in rails. They are also moving into forged wheels. So there is a good upsides which are possible based on this margin improvement, based on the order book position, based on the mining also they are moving into. So this is where these are some stock picks from the ACE equity portfolio, and that is all from my side for today. Now, if you, I would like to see the queries actually coming, and that I would like to answer for sure. So, if you look at, one or two queries have come from the cement space, and it is regarding that cement has remained a low, basically a slow mover actually. In the last 1.5 years, we had not seen cement performing, but we believe that the cement stocks, whenever they are going to increase the output price, then you will see the EBITDA per ton also improving in the cement space. So far, it is not happening with that pace, and that is the reason that the cement stocks also are, consolidating more. But there are companies which are the vendor companies to cement. For example, AIA Engineering, they can perform better. They provide high chrome grinding mills, and it is also providing to mining segment also. So we need to look at some vendor companies rather than directly looking into the OEMs, and that is something the equity market is changing. So there is, we have one query on the banking space. The question is, how do we see the banking going forward performing, because it has remained broadly underperforming sector in the last 1 year or so. So banking usually, when you see interest rate increase, then we generally see the banking stocks performing, the lending rates improve. And eventually what happens when they start increasing the deposit rates, the NIM gets shrunk, or it makes a top, which is happening right now. In fact, going forward, there may be cut in the interest rates, which may not allow the NIMs to expand more, but rather it may be more positive for NBFCs whose cost of funding will improve, and that is the reason we like the finance companies to railways and also to power segment, and that is where also we are focusing. In the banking, we believe the some PSU banks which are more linked with the corporate cycle, and with the higher corporate capex, their lending book can increase, they can perform better because their NPS are already at 10-year lows. So lastly, I pick one more question on the technology sector, that the technology stocks have recovered, and the query is on how we need to look at this space going forward. So it is going to remain interesting because we have seen when we ignore a sector, it starts performing off late. The same thing is happening with technology now. It was a underperforming sector now from 2022 onwards, because if you remember, at the start of 2022 there was a war erupted in Ukraine and Russia, and that led to the commodity prices increase, and the commodity price increase led to higher inflation, which led to higher interest rates, and higher interest rates led to the reversal of the, you can say, about the higher valuations in IT companies. So they declined, the valuations became little attractive because they declined sharply, almost 10 to 15-year low valuations we saw in the technology companies that time. Then they started recovering, and now the interest rate cut, maybe they are going forward, which can revive these stocks a little bit more. We need to see that is something that going ahead we need to see is how the situation in US, because US, the data points still are coming good. They have provided higher employment opportunity, the inflation is lower, and this is where we have to see whether actually the interest rates coming are or not. But there may be a possibility of one or two rate cuts before the US election, and that is where the IT companies are performing right now. So yes, the short term moves may be there in IT, and we need to see going forward, overall economy in US, soft landing mostly it is expected, and that is where the growth which is expected from the corporate orders to the Indian IT companies, that is what we are looking at. Otherwise, mid cap IT we have liked before. We continue to like mid cap IT because this is one segment which is the least impacted from the regional banks collapse in US. But the higher banks, the larger IT companies, they are more impacted because of that. So that's all from our side for today. Thank you very much for listening patiently. We will come back again next month with our new the next view for the month, and we will add on to some more thoughts to the present thoughts. Thank you very much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.